I started working at the age of 19. Come from a very traditional family, typical, business family and highly conservative. So we were very clear from day one we'll go into personal loan. We will not do point of sale where consumer lending comes as point of sale. We didn't want to do point of sale because it can lead to impulse purchase. We were five of us working together, just had a printer and internet connection, electricity and the abandoned home. We found all kind of creatures crawling around and somehow get started. We spent 2.5 months there and then moved to our first office in Kotla Mubarakpur.
If you're an investor in Paytm, you might be aware that the Paytm stock price crashed 20% in one day because of an RBI order which banned Paytm Bank from further operations. That is the impact of RBI and government policy on the fintech sector. In this episode of the Founder Thesis podcast, I'm speaking to Shruti Aggarwal. She's a rare female founder of a fintech business, and business is Stashfin. Stashfin is a lending fintech, and they do somewhere like about 4,000 crores of loans is the current book size which they have. So they are a massive business. And Shruti goes deep into how to set up an NBFC in India, how to set up a lending business, what is the impact of regulations on the lending business, and how government policy and private companies work together for consumer welfare and growth of the economy. This is a masterclass if you want to understand policy and RBI impact on the financial services sector in India. I'm your host Akshay Dutt, and this is the Founder Thesis podcast. Shruti, give me like uh, you know, what's the story behind you becoming an entrepreneur? Like when you look back and you connect the dots, what made you an entrepreneur?
So I started working at the age of 19. One of the conditions for I come from a very traditional family, typical, business family and highly conservative. I'm probably one of the most educated people in my family, and we are a lot of us. We are 17, 18 of us.
Where
And
did you grow up? Which city?
Delhi.
Okay.
So come from a large joint family where there were lots of kids and cousins all growing up together. And back in 70s, 80s, um, convent schools were a big thing in Delhi. So going to an all boys school, going to an all girls school, convent schools were a very big thing. Irish Irish schools and Italian schools were convent. And I went to a very convent school, that means all girls, small setup, highly conservative family. So when I wanted to go to college, I wanted a different experience, and I had got through LSR, which is Lady Shri Ram College, and I had got through Shri Ram College of Commerce with the condition, one being co-ed, one being all girls. The condition was that I have to do my chartered accountancy. So this was my father's way of making sure that I don't get distracted while in college. That means I don't have multiple boyfriends or get distracted partying too hard. So that made me actually start studying and working very hard at the age of 19. I In my third year of college, I went and did articleship with PricewaterhouseCoopers. Continued to study for CA. Got my degree in 2002, and at that point I was dating my now husband, um, and he had moved to the US. I decided to follow him because we wanted to get married. The condition to move to America was that you have to study. You can't just go there and get married, because we were all of 23, 24. So I'm
Did
like,
you meet your husband in college?
no.
Did you?
So funnily, my father did not know that we met in school. So he
Hmm,
went to an all boys school, and I went to an all girls school, which was divided it was divided by a church in between.
hmm. Okay.
But we all, for the longest time, we had a long distance relationship because he was studying and I was studying. Um, that being said, so I started my career very early. By the time I decided that this is, I've done my CA, I did my master's from Columbia University, I got a pretty good job at Merrill Lynch, and the downturn happened. And 2009, when Bank of America took over Merrill Lynch, I thought it was a perfect opportunity to actually do something of my own. I had spent certain amount of time just being an employee, and at that point in time, I started the company called Secret Cache, which was into swimwear, which was very early on. And why swimwear?
In US?
In the US. So what it was
Okay.
doing, when you would go to Goa or any places in India, you would get not a lot of variety and not good quality swimwear. And India's big into one piece swimsuits or full coverage swimsuits, what we call. The only thing that you would get is speedos, which were not fancy enough. However, the American market had figured it out. They had a variety which you would not probably even get in a Thailand or a Vietnam or a Singapore. But American bodies are slightly bigger compared to Indian. So they had full coverage swimsuits. So I started in the US because I had the most variety available to me in the US. And I started,
So this was a D2C brand in the US, selling to US customers, or you
it
were
was,
sourcing from
I was
US?
sourcing from US, and
Okay.
it was B2B2C. So um, I had a website, but I also was supplying to a lot of hotels, the Taj, the Park hotels, pretty much everywhere in Goa. I was supplying at that point in time. But it was still a very early market for India. This is, I'm talking about 2009. By 2012, when I had sold and sourced and became cash flow even, I decided to exit and I sold it to another company, because I did not see scalability coming in that in a long time. And it was the same time that we had decided to move back to India. I had my first son in 2011, my first child in 2011, and as soon as we moved back to India, I had my second child in 2012. So I was very happy being home, working for a couple of hours, helping out my father. Um, I tried a couple of things with another friend. Um, it's then I decided to take a break, and so it really started with spending a lot more time in. As an employer, why don't I try something myself, because that would give me flexibility as well as my passion in finance and retail. Let's try both of them out. In 2016, when Tushar decided to move away from private equity and start his own company, he needed
What kind of work was he doing? Just a quick
a quick
background of
background on
Tushar.
Tushar. So, the boyfriend I mentioned was my current husband, Tushar Aggarwal. Current or only husband, I would say. Uh, um, uh, you know, he was, he's an engineer. He's a CFA and a graduate from a Wharton Business School, MBA from Wharton Business School. He had a long stint at Goldman and Lehman before he joined private equity with General Atlantic in New York. And then in India, he worked with private equity company Everstone Capital. During his work with Everstone Capital, he had seen investments in NBFCs like Indostar and Kisan Dhan, and that's really how the idea of Stashfin came about. When he moved back to India, um, he did not have a credit card because he did not have a work history in India, while I did, because I'd worked with PricewaterhouseCoopers. So opening a bank account, getting a credit card, both was very hard for him. However, they were relatively simpler for me. He was called new to credit, even though the economic bracket he came from, or the salary he was drawing, was on the higher side compared to what an average Indian would draw. He did not get approved for a credit card. And in India, the belly of India is really the middle class, who may or may not have access to credit, because the penetration of credit in India is low, and they may not be bankable enough for the banks because of the low ticket size. So Stashwin came about with that thought process. It was a paper plan when he went and raised pre-series seed round of funding. Our first investor was Chris Colanati of Snow Leopard. He actually Snow Leopard Ventures. The company started on in Feb 2016. It got incorporated, and our first check was uh, in our bank account on I think 10th or 12th of April. So Chris Colanati has been supporting us from the beginning, and eventually the other uh, early stage investors came in. So we bootstrapped everything, forming, applying for NBFC, everything ourselves, but really touched the investor money when we had the um, full commitment for pre-series A of $5 million. We started the company with 4 or 5 of us. We first started the company in the backyard, or what we don't have many backyards in India, but the drawing room of my father's abandoned home. Um, so we were 5 of us working together, just had a printer and internet connection, electricity, and since it was an abandoned home, we found all kind of creatures crawling around. You would have lizards and you would have rats running around, but we knew that we had to move on and somehow get started. We spent 2.5 months there and then moved to our first office in Kotla Mubarakpur, which is opposite Defense Colony. So it's Defense Colony being the fancy part of Delhi, and Kotla being the village around Defense Colony. That's where we started, and we grew. In 2017, we got our NBFC license. It was a very unpopular thing to do, to be capital intensive business. NBFC is a very capital intensive business. Money is your raw material. Every dollar of equity you get, you have pressure to get $4 in debt so that the business grows. At that point in time, there were a lot of our a lot of conversations about companies like MoneyTap, companies like Walnut, and companies like Pesa Bazaar, India Lens, which were asset light businesses and were doing the same job but deploying someone else's capital. However, at that point in time, we were very clear that we need to control our own destiny. Relying, if you really believe in the business model, you'll put money where your mouth is. So NBFC was the right criteria for us. We started small. We started, I think, the first month when we did 4 lakhs of dispersal.
Which month is this? When did you get the license?
We got our license in Jan 2017.
Okay.
We got in the record time of 2.5 months. So we
Yeah,
finished the
I mean,
application.
I think it's not easy to get an NBFC license, right?
No, it's
Like,
not an easy. It's not an easy thing to get an NBFC license, and but we got. I think because we coming from completely professional services and great investor backing, we got in record time of 2.5 months. We started the business. So we started the pilot business at that point in time. There were enough NBFCs in 2016. There were enough NBFCs looking to grow their business, so they would do lead sourcing through us. So even though we got a license in Jan 2017, we were doing business through other NBFCs. So our first month of dispersal was actually September 2016, and that month we did 4 lakh of dispersal, and we were
so
quite
I just want
excited.
to like clarify a few of these things for our
Mm.
audience. So essentially, there are like two models of lending fintechs. One is where you are a marketplace connecting borrowers with lenders, and here you don't need a license. The lender has the license and the capital, and you are connecting them to the borrower. And the arrangement could either be you have skin in the game through a first loss default guarantee, or you're purely marketplace just doing the connection and that's it. It's like different levels of engagement you could have. Or the other is you actually become an NBFC where you are lending from your balance sheet, and so you started with the marketplace kind of a model, the connector, and then by September you started lending in your own books, I guess. That's what you, by January of 2017 when you
2017.
got
So in
okay.
So we were testing out the waters. So what we did at that point in time in 2016, the first loss demand guarantee guidelines were not there. So we would make them whole for any risk. They would get a guaranteed return, and you would make them whole for any risk. So even though we didn't have a license, practically we were taking all the risk on our book,
Hmm.
risk on
Okay.
our balance sheet.
Right. Okay. Okay.
So the idea,
And what
the idea.
market did you want to tap into? Like consumer lending, SME lending, unsecured, secured. Like there are many different loan categories.
So we were very clear from day one. We'll go into personal loan. We will not do point of sale. So where consumer lending comes as point of sale, we didn't want to do point of sale because it can lead to impulse purchase.
Point of
Uh,
sale is what, like, say, a Bajaj is famous for,
yes,
like
it's yeah.
Bajaj
So it's a
Capital.
point of sale,
Like
or
when
you
you're
would.
buying a TV, buy it on EMI, that is a point of sale loan.
Right. Or even if you are buying it at Tata Chroma, or if you go to an Apple store, you can do financing of your gadgets.
Right.
We did not want to do point of sale because we didn't want to encourage impulse purchases. We wanted people to be, so the idea about doing this was we wanted to people to make sound decisions and not be large ticket size borrower as well. Um, we started in so that's when we started to
So
fall out. Go
you're
ahead.
saying personal loans is not large ticket size as compared
Not
to.
ours, not ours. So what we were targeting was the when I mentioned that we wanted to focus on the belly of India, where the 200 million households, they have a bank account, but banks may not find them bankable enough because of the size. Banks make money because um, the larger ticket size they give, uh, it has a higher return for them. For us, since we were always digital and we decided to always be digital, the ticket size really didn't matter. You could come and take a small ticket size loan and repay back without worrying that carrying negative carry. If you want to do a, for example, if you are, your salary comes by 5th of the month, and you have to, and for example, an aspirational individual in India finds a good deal to get his scooter repaired. Now he can't do, even though he may or may not have a credit card, there are only two options he has. He can go to a bank to get a loan, for which he has a minimum ticket size of say 2 lakhs 3 lakh rupees, or he goes to a loan shark. There is nobody servicing that criteria in the country, where you can take a ticket size. You may be approved for a 50,000 or a 1 lakh or a 2 lakh rupee loan, but your really need is of say 5 to 10,000 rupees. You don't
Hmm.
want to pay interest on the 2 lakh rupees while your need is only for 5 to 10,000 rupees. And that's where we were coming in.
Okay. So is this profitable, such low ticket sizes? Because if you're giving a 10,000 rupee loan, you would be earning maybe 500 rupees on that or something like that, I'm guessing.
So it is profitable. So unit economics, what we solve for is unit economics have to be profitable on day one when you're building out a business. So and what we've noticed, if when when you are taking a loan of say 10,000 rupees, if you're paying 100 rupees extra, the customer is not really thinking about it. They need, it's the timing that matters, it's the convenience that matters, rather than paying the 100 rupees extra on that. So from that perspective, the convenience cost to a customer is very little comparative to what you would take if you were taking a larger ticket size loan. That's why we've been profitable. Also, our operating cost is very low because we do not have branches. We can service a customer digitally within 5 to 7 minutes for the first time customer, and 90 seconds for a return customer. So it has been profitable for the last 3 years. The NBFC has always been profitable, but when we look at the company, so how we structured, our investors are sitting at a Singapore entity. and we have operating entities in India, but we look at our entire company, or we look at the Stashfin brand as a group of companies. And as a group of companies, we've been profitable.
Okay, interesting. What is the maths here, if you can explain? Like, how much is the average interest you earn, and how much is the average cost of capital, and what is the margin?
Sure. So the average interest rate we are charging our customer is 34%. Our cost of funds is half of that. Uh, then what we charge, the difference gets covered in the form of operating costs, which are close to 5%. Then we have what you call credit cost. Credit cost comes in two formats. It comes as ECL, expected credit loss,
Okay.
uh, and it is bad debts.
What is the difference, ECL and bad debt? They
ECL
sound
is
similar.
something, yes. So NPAs are non-performing assets, are assets which have crossed 90 plus. Okay, and since we are SEBI regulated, in the public, when you're SEBI regulated and you're giving out, when you have your bonds listed in the exchanges, you have to move to Ind AS. The two formats of accounting in India, Ind GAAP and Ind AS. So we get covered by Ind AS. So any loan I give out today, or the company gives out today, say 100 rupee loan company gives out, what is the amount that will finally go to 90 plus has to be provisioned on the day of dispersal. So if I give you
Okay.
100 rupees, I think it's going to be 5 rupees that's going to go bad. Out of a cohort of 1,000, I have to provision it on day one. And what finally moves away from the book, that means, whatever your write off policies, in our case is 180 plus, that completely gets moved from the PNL and goes away from the balance sheet. So it's a combination of two ECL. So credit cost is a combination of ECL and bad debts. For us, that number is anywhere from 4 to 5%. So the average ROA which we get is close to 4 to 5% in the company.
Okay, understood. Understood. Um, can you help me understand these numbers with context? So, for example, 34% is what you charge. What would
So out of the 34%, it's very
other
important to
people be
note.
charging? Other
Yeah.
players?
So it's very important to note, even though you're charging a customer 34%, in our case, what we provide a customer, what we call a free lookup period, free credit period. The customer can come in and the customer can come in and pay the entire loan within 30 days without paying any interest. So there's no foreclosure
Okay.
charges, there's no processing fee. What the customer is paying is only a transaction fee, which is close to 24%. However, it does not have any NPAs because the amount comes back to us. So when we look at the balance sheet of the company, the yield on the company, because we are now providing convenience and attracting better quality customers, the yield on the company is now below 20%. It's not 34%. However, we peg ourselves to a credit card where if because we're providing the 30-day free lookup period, no charges, no nothing, processing fee, no interest. ICICI charges close to 3.85% if you take a loan from them on card. HDFC charges close to 3.55% per month. So we've pegged ourselves to a credit card because of the product we offer to the customer.
Okay, very interesting. Yeah, this is exactly like a credit card. Like in a credit card, you can spend for X number of days before you have to pay it back interest free. And if you don't pay back interest free, then you start paying interest on it. So there's very similar to that. You get
Very
the cash
similar to
in
that.
your bank. The
Yes.
only thing is you're getting cash in bank here instead of an instrument which you can use. What is the reason to not do an instrument? You could have done an instrument, right? Like a
So now I can probably talk about the guidelines that happened. So Stashfin really started with what we call the Stashfin credit line card. It was first sponsored by DCB. then came Federal Bank, and then we started with SPM Bank. So we did launch that
This
product.
is a prepaid card.
It's a prepaid card. So what would happen? The customer would come and say, I want a 1,000 rupee loan. The money would go directly into the customer's PPI account. That's a PPI card,
Prepaid instrument, right?
prepaid instrument card, and then the customer could use that card, say at a restaurant, or go to an ATM and withdraw money, or could go buy a phone, for example, or an accessory of a phone, or even for someone to repair their a two-wheeler, they would go withdraw the money from the ATM. So we did launch that.
And the
uh,
interest would be chargeable only when the money is used.
no, so money interest would be charged from the day you draw down the money into the PPI. So the PPI in itself is zero amount. It only gets money into its account when you do a active transfer. So all this was linked through our phone. They did our app through their phone where
Okay.
they could
Okay.
control it,
Okay. Got
and they
it.
would
So
get
you have a
reminders.
drawing limit on your app. Like on your app, you can draw up to 10,000. And then from that drawing limit, you put 5,000 into your card and then you use the card for that 5,000. Okay.
Multiple ways. And
Hmm.
also, what you do, if you could lose your card, you could go onto the app and block your card as well. So there's
Hmm.
no misuse.
Right. Okay.
And you could
Hmm.
set your pin. There were a lot of things you could do. You would get in your OTP to withdraw money from an ATM. So and all these were free features of our PPI card. um, if we always compared ourselves to a credit card. um, if you have to draw cash from a credit card, you have to pay, say, I think 2%. In our case, you don't have to. You
Hmm.
just pay the interest on what you've drawn down, or if you don't decide not to pay in 30 days, and or just pay the interest what you see on the app, what you've been underwritten for. So this, we've underwritten close to 30 lakh customers, and what we see, an average customer interacts with us 10 times a year. So from that
What
perspective,
does interact mean here? Like he comes and takes additional, or he draws from the drawing limit, or
yes,
like
so
what?
if you're approved for a 1 lakh rupee limit, but your need is only for 5,000, the balance 95,000, if your credit conditions don't change and you're paying our EMI on time, you will continue to get access to those 95,000 rupees.
Okay.
So that so
Understood.
they could do 20 transactions of 5,000 rupees. So
Hmm.
when I say
Okay.
interacts with us, that's what I mean.
Got it. Okay. Hmm. Right. So we were talking of why not prepaid instrument. You told me you started with a prepaid instrument.
We started with the prepaid instrument in I think in the year 20 June 2020, uh, June I know September 2023. RBI came up with the guidelines where an NBFC cannot use a prepaid instrument.
Okay. Only banks can.
Only
Uh,
banks can, and
okay.
that's when it changed. The card went away. However, that didn't change much for us, because we would give the customer an option. Do you want money in the bank account? Do you want money on the instrument? So for us, it was a simple thing to disable the PPI card option. And at that point in time, we also saw a lot of movement in UPI. People preferred taking money and doing transactions on UPI, and UPI has grown tremendously compared to credit cards or even debit cards in the country.
So the Stashfin app has a UPI payment feature inbuilt into it. So instead of putting money into a prepaid instrument, you can just scan and pay directly with the
No, we
Stashfin
don't
app.
have that feature. We don't
Okay.
have that feature. What we have, that a person can transfer the money into the bank account. From the bank account, the customer, most, with the
UPI,
penetration
right.
of UPI, then you use any of the apps which you have on your uh, phone to do the UPI transaction, because UPI transactions happen through the bank. Credit
Okay.
cards are also been
Okay.
limited.
Okay. There is credit on UPI also, right? Like through Rupee or something. But then again, NBFCs are not allowed. Some, I guess there would
NBS,
be some.
yes. It's only open to banks.
Okay. Okay. Okay.
It's not
Okay.
open to it's
Hmm.
not
Hmm.
open to NBFCs or even small finance banks yet.
Mm-hmm. Okay, okay, got it, got it. So, while we are on regulations, I want to go a little zoom in on this. So, what has been the evolution of RBI stand with respect to credit over the last 6, 7, 8 years that you've been observing this industry? Can you take me through that? What was it like when you started, and how has it changed, and where is it today?
So when we started in 2017 with our NBFC license, um, you know, India was still evolving at that point in 2016, end of 2016. We got the GST. There was demonetization. Followed in 2017, there was GST adoption. So a lot of changes were happening across the ecosystem, not just RBI. The RBI really did become active in the NBF in the fintech space or the unsecured lending space during COVID. I would say it started with moratorium. Where the funny thing, there's no Hindi word for moratorium. When you would say
Okay.
moratorium, you would people would say EMI maaf. We would write no, no,
Ah,
no. This is not
okay.
EMI maaf, and we had to make um, a whole like a video series on it's not EMI maaf. It is basically delay your EMI, but you continue to pay interest. Since
Uh,
we were small ticket size loans, we encouraged all our moratorium videos were like, if you have extra cash, please pay us down because it's not worth paying interest on interest. And that's how really it started at that point in time. We saw RBI getting active. This is March 2020. Then came the ex gratia rules in November
the what
20.
rules?
Ex gratia. So ex gratia
Okay.
is that any customer who had been paying through COVID, you had to compute their interest on simple interest basis and pay them the difference back if they've paid any compounding interest. So it was very interesting how RBI was making sure that NBFCs continue to make money, but they put some money back into put. So what we do is reducing interest calculation in our amortizing schedules, and RBI wanted it to make it into simple interest. So what they wanted to do is put the extra money back into the customer's hand, and whatever the difference was in between the reducing interest method and the simple interest method, they compensated the NBFC. So there's no loss to the NBFC, but the fastest way to do it was ask the NBFC itself to give the money back. So in
Hmm.
November 30th, I remember we had to give close to 30,000 customers the difference because they were paying customers for us. So we did that. We participated in the scheme, and I think it was a very successful scheme by RBI to make sure there's money back in the economy. And they used SBI and NBFCs to do that. All the banks also participated. A lot of, I don't know if you ever noticed in your credit card, if you were continuing to pay your credit card balance, you would have probably received ex gratia as well. This happened across housing loans, home loans, credit cards, personal loans, pretty much all kinds of loans or credit in the country. Then
One,
it's
I want to slightly dig a little deeper here. Uh, can you explain with some numbers what is the difference between reducing interest and simple interest?
I actually don't have those numbers. I can probably send you an Excel later.
Now,
Make,
just as
make
a hypothetical example, if I took a loan of 100 rupees and
hmm.
interest was 10%, so I'd pay 10 rupees if it was a 1 year loan.
So
But if
generally
I'm
speaking, अगर मैं if I would say our interest rate is 34%,
hmm,
okay, uh, I'll say, largely speaking, how it works. Effectively, the simple interest turns out to be 21%. The
okay,
difference is almost 20% in that case
okay,
between reducing balance and simple interest rates over say a tenor of 1 year
okay,
or two
okay,
years.
okay, 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 got it. Okay, I guess
However,
reducing balance, you will add some of the interest back into it or something like that, and therefore it is that effective.
so what happens in reducing balance? In reducing balance, the first half tenor of the loan where interest payments are very high, the principal amortization is less.
Got it. Okay.
And in simple interest, your interest remains the same
Hmm.
throughout.
Got it. Okay. Okay. Understood. Okay. Got it. Got it. Okay. So yeah, we were talking of RBI's stand and how it has been evolving. So RBI did this to put money back into the economy.
Back into the economy, and it was run through banks and NBFCs or anybody who was part. And it was optional. It
Hmm,
wasn't something that RBI made sure that everyone's participating, but it was a great initiative at that point in time, to put the money back. There was the difference between, and RBI really did pay or back us on time, so that our financial year closes very well as well. You don't reverse your income. So
hmm,
by 31st of March, we had received all the money which we had given out to our borrowers.
hmm.
Um, and this was in the form of either checks going out, bank transfers happening, or reducing, if there were current customers, reducing their uh, payment
Outstanding.
burden outstanding through their SOAs.
Hmm,
Um, it's only then, in I think February 2021, RBI got active, and there was a lot of noise about suicides and Chinese apps,
Okay.
that
Hmm.
RBI became active and it
The
started.
harassment for recovery of
Yes,
loans.
harassment of recovery, crazy rates being charged,
Hmm,
doing business in an unregulated manner. I think RBI's biggest concern was, credit can only be given by regulated entities. Who are these? So, what you spoke about, uh, two market models, being one regulated, one unregulated, where you could get connect borrowers and lenders together. There were others who were also doing borrowing and lending without being regulated. And these apps came, I think there were close to 1,500 apps RBI published in Feb 2021, that got discontinued. And that's the time we really saw engagement by RBI. It was our first few interactions with RBI at a different level, where we would talk about KYCs, because the entire model had gone digital. Even though we were doing digital, defending our business model at that point in time was slightly different, because people were used to traditional way of working. I think COVID changed everything for everyone across the world, and fintech was no different. Uh, RBI wanted to learn, so we had multiple meetings with RBI on KYC norms, and that's that point in time when Aadhaar or KYC also became very, very prevalent and highly adopted, and it's all driven by RBI with the KYC regulations, etc. So, um, you know, I think the biggest concern for RBI is you cannot do credit if you're not regulated, and that's what they really clamped down on. And as they started interacting with us, the different rules came about disclosures, fair practices codes. Are they being followed? Um, you know, why would
Disclosure
someone?
as in disclosure to borrowers before they take the
Yes,
money. Okay.
exactly, exactly. So what eventually came out was the digital lending guidelines
Okay.
that came in June 2022. But
Digital lending guidelines, you said this
digital
is.
digital lending
Okay.
guidelines, and this is all make sure fair practices code. There's no impulse purchase happening without the customer refuting charges, because they're lost for both, for the lender and the borrower. It impacts
Hmm.
the borrower's credit history, and it impacts the lender directly financially. So all
Okay.
those disclosures really came about in Jan 2022. In September in September 22, the RBI came up with the PPI guidelines as well, which I touched upon, where you could not.
Why? So you told me the reason for the previous guidelines, but why the PPI guidelines? What's the reason for that? Like, was it being misused that they wanted to clamp down?
Um, I don't know the reason, honestly speaking. Um, but what we understand credit cards are in the industry for a reason, and PPI cards, RBI saw very similar to credit cards, which NBFCs are not allowed to do, only banks. And there's a special license you need for credit cards as well. It's not
Okay.
that all banks have credit cards.
Okay. So the PPI card was a credit card
Workaround,
in the garb. Yeah, it was a
yeah,
workaround. Yeah, it was
workaround
a
for
hack
credit
to.
card. Yeah,
Yeah, yeah, it was a hack to give a credit card to a customer without having a credit card license.
yeah,
Got it. Okay.
got it.
Okay. Understood.
And credit cards are also what they call regulated.
Hmm. Okay. So RBI sees credit cards as tools of payment, like convenience and payment, rather than tools of lending.
No, it looks at lending as well. So credit
Okay.
cards, the three kind of credit card customers.
Hmm.
Uh, One are transactors, where you would pay the full usage amount back on the date it's due. Then there are revolvers, which will only pay the minimum due, and the third ones are who take loan on card,
Hmm. Okay.
who know from day one that if they're making a large purchase, they need to take a loan on their card for
Hmm.
it.
Okay.
And so it is a credit instrument, and surprisingly there are only 30-40% of the customers who are transactors, even for the largest credit card companies.
Okay.
Credit card companies make money through revolvers and loan on card.
Mm. Okay. 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 Plus the MDR, but that is like
Of
pennies
course,
on the
of
dollar.
course. Yeah. So
Uh,
those are MDRs, you know um, are also there, but they're also shared by, say, a Visa or a Mastercard, etc.
mm, mm. Okay. Okay. And MDR for our listeners is the merchant discount rate, which is about 1 to 2% that
Yes,
is charged to
absolutely.
the seller is bearing that amount. So the seller, instead of getting 100 rupees on a transaction, is getting 98, 99 rupees, something like that.
That's correct, and that also they have to share. It's
Hmm.
not fully theirs.
Right, right. The banks and the network like Visa, Mastercard, between them they share it.
Absolutely.
The issuing bank, the card, the acquiring bank, all of these. Okay, got it. Okay. What is? I wanted to understand a little bit on the Chinese loan apps. What what is the way in which they were lending? They had a tie up with an Indian lender, like an NBFC or something, or they just had money in their, like, say, a current account which they were giving out to people, or like.
So we did not know this model existed. Okay, so we only learnt about it in February 2021 during our interactions with RBI. So what we understand, what was happening, the money from um, a third party would come into an escrow account, which is jointly held by the NBFC and the provider of the funds. From there, the money would go to to the borrower. Then the borrower would pay back into the escrow account, and from the escrow account would go back outside the country.
Okay.
Because escrow accounts are not
The amount
reported,
going out of the country is the interest amount only,
we
not
don't
the
know. I wouldn't know the
principal.
details.
Okay, okay.
What I understand, it could be the principal or the interest, or it could be, I wouldn't know the
Hmm.
details of what kind of amount was going. I'm talking about the mechanism, what we understood.
Yeah, right.
Because
Sorry, I interrupted. You were talking of what escrow account. Yeah.
yeah, so escrow account does not show up in the balance sheet of the NBFC, because it's not the NBFC's money.
Hmm.
Only their share of the money would get reported in the balance sheet, not the excess money which is not theirs. So this was the mechanism what we understood was being used to route the money to the end borrowers, and recovered from the end borrowers as well.
Okay, okay, okay. And the harassment was happening largely through data scraping. Like they would scrape the data of all your contacts and all of that from your device. You have to give it a lot of permissions, and then that your contacts would start getting like messages saying he has not paid or stuff like that.
That I
Like
think that
social.
came, yeah, I think that came a slightly later with the with Google becoming very, very active. So Google
Hmm.
would not give permission. They would want to see whether you're regulated or not regulated. They would ask
Okay.
you for your NBFC license. They would ask for a lot of stuff, and then they would ask reasons why would you want access to someone's photos, why would you want access to someone's um, contact list, why would you want access to someone's email, say, different things. And that's where Google really came about,
Okay.
helping the apps, or
Hmm.
restraining the apps.
Hmm. Okay.
and i
Okay.
and I think that was driven by RBI, but we wouldn't know directly because we were dealing directly with Google to get updates on our app.
Hmm. Okay. Okay. Got it. Got it. So, end of 22, you said the digital lending rules came about, and then
So
23, the
around,
PPI.
yes,
Yeah.
around middle of the year, June
Hmm.
2022, then came the PPI guidelines, and
Hmm.
in June 2023 came the FLDG guidelines, what we call first clause demand guarantee loan, loss um, guidelines for co-lending. And that's when you know there were stricter checks by RBI on who's doing the credit assessment, where is the money going from, how is the money getting accounted for, is there full disclosure, is the credit decisioning happening on one side or two sides. All that stuff came into picture in June 2023.
And are these marketplaces allowed to take credit decisions? What is the
So the
guideline?
credit decisions can only be taken by certain things an NBFC can't outsource, like a KYC and the credit decisioning.
Okay.
They can't outsource. And
Hmm.
what RBI also came about saying that the law first loss demand guarantee cannot be greater than 5%, whether
Hmm.
you are a platform or you're an NBFC.
Hmm.
So anyone you're giving a loss guarantee cannot be more than 5%.
Okay. What's the impact on fintechs of this regulation? Because so you are an NBFC, so for
Right,
you it would probably be a positive thing because you have anyway been doing the decisioning in house.
right.
But there would be a lot of legacy NBFCs who would have worked with these fintech companies, like say a MoneyTap or whatever. I think maybe MoneyTap also has an NBFC now, but similar companies. So, what is the impact on them of these regulations? Would they have had to reduce their loan book or increase the time it takes to disburse a loan, or like?
So I can talk about our business, how it got impacted. We did see that folks who were not very uh, technology savvy, for us, real time decisioning was most important. So for us, we did see couple of our lenders say that we do not have the capability to do the credit decisioning real time.
Okay.
It will take us some time to get the APIs in place. This is do we think this business with 5% loss guarantee, is it sustainable? You know, all those questions started coming in. So we did see a couple of folks reducing the exposure at that point in time.
Okay.
And
Okay.
what we understand from the general market, that this continues.
Hmm.
It's
Okay.
it's not that co-lending. I think it was the idea was to curtail that if you've not got a lending license, don't do lending.
Hmm.
The idea was
Okay.
that.
Okay. Okay. Okay, okay, okay. So, in a way, the free flow of personal loans is kind of getting restricted over time.
So,
With
so what RBI was looking at, that if someone started, say they've got, say, $10 million in funding, their leverage was 20x, basically.
okay, because
500
five
divided by
percent
5, yeah.
less
Okay.
default. Okay.
While an NBFC, our leverage can highest go to is a 4x.
Hmm.
So there was a lot more happening which was unregulated.
Hmm. Okay.
And there was
Can you explain? Yeah. Sorry. Please finish your.
yeah. Explain.
Can you explain the concept of leverage? Leverage is super important in the lending business. For someone who's not from this back industry, like what is the power of leverage here?
Power of leverage. So India has moved away from being a savings economy to a bit of a credit economy, while America's has always been a credit economy. What this really means is if you're earning 100 rupees, you can buy something that's worth 1,000 rupees, and the difference 900 is called leverage, where you go to a bank and borrow that money. There
Hmm.
are guidelines by RBI on leverage. Why is it important? Because you do not want people to be in a perpetual debt trap where they earn all their money and pay to a lender. They need money for their household expenses, their growth, emergency funds. So RBI cares about it a lot, and so do we. And the guidelines are there for a reason. So what?
Hmm.
And RBI controls leverage. This is how the growth in the economy happens. And when you have more money in the hands of folks, which RBI uh, did not know about, it can cause pressure in the economy, and it can impact individuals and companies. For
Uh,
example, for
no,
example,
I mean, I
go ahead.
wanted to understand leverage from the point of view that as a business,
Hmm,
if raw material is money for you,
hmm,
right? You need to acquire money to lend it out. One
hmm.
way to acquire money is raise funds from investors, and
Yeah.
then you apply leverage on that to increase the return that you are giving to investors on the money
Hmm.
that they have given you. How does that work?
Right. So how does it work? So leverage is basically the idea is to earn money by providing to end borrowers, and what you're earning from the end borrowers should be more than what you're borrowing. The borrowing rate should be higher, and the return on equity, what you provide to an investors, is higher when you have higher leverage.
Hmm.
But
Right.
yeah, but for I don't think RBI is concerned about the equity
Hmm.
investors. They're more interested in their uh, uh, you know
Consumer.
general public,
Hmm. Hmm.
that they are not borrowing which they can't afford to pay.
Okay, okay, okay. Understood. You said that there is a 4x leverage which you do, or so if you raise, I think till date you have raised about $150 million. So which means that you would be able to lend four times of this or five times of this, like another 4x amount you can get from the market. Uh, so this individual lending institutions will do an evaluation and decide how much money they should give you at what rate and things like that. Like how does that operate? Like how do you
Well,
source
yeah,
your raw material here? That's what I'm
sure.
trying to understand.
Sure. So I'll just correct certain numbers. We've raised close
Mm.
to $100 million in equity,
Okay.
and it's the $100 million of equity has come at various points in time, but
Mm.
as of today we have close to $100 million of equity, and whatever profitable profits uh, uh, we've earned get added to the net worth. So
Right.
together the investor money plus profits and minus losses what we've had in the past get net off, and that's what's called the net worth. Based on your net worth, you go raise money. So then the value really comes from the net. And you want to earn for you would ideally in a very effective operating entity, 4x leverage is very very common. However, fintechs or new age companies are slightly find it slightly hard to reach 4x. For us, our holy grail is 2.5x, which we
Okay.
reached in September 2023 before the guidelines became very, very active. I haven't finished the conversation about regulation, but I would like to talk about that at some point in time again. So 2.5 is what we put in our business plans and would like to solve. So what happens of every 100 rupees of uh, investor money we raise, we want to get debt on it. So we'll go reach out to a bank like an SBI in public sector space. We'll reach out to a small finance bank maybe like a Surya Uday or an AU Bank, or we would go reach out to an NBFC like a Hero FinCorp or a Bajaj, and then we'll go to HNI's, private wealth space where we'll showcase through maybe a platform like ILFS or IIFL or a vendors or GM Financial. We'll showcase a story, and they'll do fundraise for us. They'll get a bunch of HNIs together. They'll do it like that. Uh, what a NBFC does, like a Bajaj, they would be borrowing from a PSU, or a Chola would be borrowing from a PSU at a lower rate, and they would charge a premium and lend to us. Banks, similarly, um, uh, an SFB bank would probably have access to CASA or other bank borrowings, and they'll charge a premium and lend to us. And similarly, SBI would do the same thing. This is how it really works, and we will then charge a premium on what we are getting as cost of funds and charge the end borrower. And that's what we
Okay.
called net interest margin, the NIMS. So, NIMS are a very important part of any lending business, and that's why unit economics have to always work. Just
Hmm.
to capture a customer, if your NIMS are not priced correctly, you will never be able to make profits.
Hmm. Okay. 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 Understood. Uh, what is the reason that fintechs are at 2.5x as the holy grail? Is it because they are new and they don't have the
Yes,
history? Okay.
they're new. They are still there's a lot of regulatory changes happening. You know what MFIs were back in 2008, 2009 is what fintechs are today.
Hmm.
It will take a bit of time for the dust to settle and regulations to come in place. So, in fact, when I was talking about over leverage in November 2023, RBI came with risk weightage assets. What that meant, that anyone who is doing unsecured lending, whether when you do a lending which is not backed by an asset, say it's not backed by a home loan, or it's not backed by uh, you know I wouldn't business loans are also or maybe not backed by goods. For example, if you're doing you're selling mattresses, say your goods become mattresses, what did you call inventory backed, all those were classified as unsecured, and the cost of borrowing for unsecured increased. What that meant, if a bank had to do a certain, what we I spoke about, provisioning, the the Basel III norms where banks have to provision at a certain level. That level had to increase by 25% if you were doing any kind of unsecured lending. So for folks like us in the unsecured space, the cost of borrowing increased.
Uh, just want to ask a little bit here. The Basel III norms apply to you or to the bank who's giving
To
you
the
loans?
bank, to the bank. So
Okay.
we borrow from the banks. So
Okay.
all the three
So the banks
early,
see loans to you as unsecured loans.
yeah. So no, they lend to us also as unsecured because our end borrowers are also unsecured, right? The
Okay.
end use is unsecured
Got it. Okay. Okay. Understood. Okay.
because
Okay.
we do
Okay.
not have inventory to give it to them.
Hmm. Yeah, there's no asset which you are uh,
Yeah, it's
giving to the bank for that. Okay,
that's
okay,
correct.
okay. Understood, understood. Okay, okay. And so provisioning means that amount they have to set aside as possible loss, and so therefore
Yes,
they have to charge you higher because there is a higher amount
yes.
which they have to set aside as
Yeah. So
possible loss.
the profitability gets impacted.
Hmm. Okay, okay,
This
okay.
was to control leverage in the industry.
Hmm. Okay. Okay, okay. Uh, what are so okay? Let's finish the RBI journey first. Then I have a bunch of other questions I want to ask you.
Yeah, sure.
So RBI came up with these guidelines on how to categorize and provision for unsecured loans. After this, any other major
Yeah,
milestone?
so in again in December 2023, this time around with RBI's directive, stricter regulations were put in place, and Google was forced to remove another 2,500 fraudulent, 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 2,500 fraudulent lending apps from the Play Store. So this journey really started in Feb 2021, and in December 2023, the direction was given to Google to remove these, and a whole list was published by RBI of fraudulent apps. It was the first time that came up on the RBI portal, that these have been banned. Few other regulations came into place in August 2024. We saw RBI's ban on tenor linked assured returns and liquidity options for P2P. So P2P was to
Peer to
P2P,
peer.
yeah, peer to peer companies are also regulated by RBI. They are like platforms. They are like it is a platform where they connect the borrower and the lender. However, the P2P companies were offering guaranteed returns to to the lenders. So regulations around that came up, and in the most recent, in October 2024, RBI put embargo on 4 NBFCs because of their lending rates and other practices, um, uh, which were related to interest rates and accounting, etc., of which one of them has already opened up, but it has had an impact on the industry, not just fintechs, but MFIs as well. So the entire NBFC industry has been impacted as well.
Okay. 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 Like credit is not as free flowing now as it used to be a couple of years back.
So we can see a difference.
Hmm. Okay. 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 Uh, do you feel that this is a positive move or a negative move? Like,
So for us, every RBI change has been very, very positive. Talking about digital lending guidelines, for us, we've always moved, our business model was never to do impulse purchase from day one. So for us, it was like, it's about consumer education. It's not putting people into a debt trap, and putting it down on paper, I think really helped getting clarity what RBI wanted. Then when the FLDG guidelines came in for over leveraging and putting, it was very often when we were doing the business, we were said, oh, this app has become very, very popular. Two kids out of college could start a fintech. Now
right.
there's
Yeah. 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 Many
now
examples of that also. Yeah.
yes, yes.
Yeah.
Now it's more about compliance comes first, leveraging comes equally important. You need to have money in the bank account before you can actually start a fintech. And then the PPI guidelines, we knew UPI was anyway taking off. So from day one, we had built out taking dispersal both in your bank on the PPI card. So for us, that was also, while some people were still figuring out their business models, it was very easy for us to switch off and have all the dispersals go to the bank account. Have things become slightly tougher when you're underwriting a customer? Yes, but I think as data privacy laws come into place, it had to happen. It is not allowed in the rest of the world, and India's, I think, in the forefront of digital lending in terms of just fintech penetration. And I'm sure RBI is seeing a lot more data than we are to know why they've put these in place. The increase weightage, again, this is more to make sure that you're not over leveraging an existing customer. Um, that's also helped because when we are giving money to a borrower, if someone's not reporting it because they're a fintech and they're not re- required to report because they don't have a format to report, it becomes hard for us to collect as well. We did see a slight increase in risk in that period, and we can see things normalizing now, as every 12 to 14 months is a cycle. So this is all settling down. And regulations there for a reason, regulated entities are there for a reason, and RBI putting this on paper that you're a fraud, they're not a regulated entity and taking loans from them, I think it's just had to happen.
Hmm.
You can no more be doing business funny way.
Hmm. Have you seen any difference in your growth rates?
Yes, we have.
Okay.
So I think before risk weightage came in, and before the FLDG guidelines, we were growing quite rapidly. We had access to capital more easily, and since then we've seen reduction. And I think these numbers are all there. Bank funding to NBFCs went from 23% to 8%. These numbers are
Wow.
out there. So it's not just us who are feeling
Mm.
the pain, but I think it's just what RBI wanted to do.
Okay. What are your, like, some numbers you can share? Like, how much do you disburse every month, and what is your loan book like, and like,
Sure.
would-
So our loan book is close to 2,000 crores.
mm.
We disperse close to 300, 400 crores per month. We underwrite close to 90,000 customers a month. And yes,
And what is the
and
average tenure?
average tenor. So again, what I said, the choice the customers make
Ah,
versus what
okay.
is slightly different.
Right.
Um, for us, if we have to take that into place because of the convenience of the product, the average tenor on the book turns out to be 9 to 10 months.
Mm.
However, contractually, it is close to 16 months.
Okay, okay. And this 300 crores monthly dispersal, how has that number evolved? Like, what was it earlier? And
Sure. So close to December 2022, we were around this number 300, 350 crores, between 300, 400 crores. In May 2020, December 2022, we were 300, 400 crores. May 23, we went to we went to 500 crores. And when the
oh,
risk weightage came in, it reduced again to the 300, 400 crore mark. And we've been consistent with that number.
okay, okay, okay. Understood. Okay, okay. So, couple of like broad themes. Let me start with uh, uh, on how you source money. So you said that it is tougher to source from banks. What are the other ways? Like you told me that you have bonds and therefore you are SEBI regulated. So bonds is sourcing from like HNIs, or what are bonds for?
Yeah, bonds are so RBI's new SEBI new guidelines and RBI's new guidelines. 25% of the capital or the borrowings for an NBFC now have to be from the capital markets. So
Okay,
RBI encourages you to go to the market and get money in the form of, say, commercial paper, bonds from open, public.
okay,
Uh,
okay.
so this is something that's again come up as a regulation. And what we do, we list our bonds. We go to SEBI. We say that we have a demand to raise, say, 10 crore of rupees from these five individuals. And SEBI has also become very, very active in the space where they've introduced what we call an investment banker. If you're doing denominations less than 10, denomination up to 10,000 rupees, you need to now get an investment banker who certifies your numbers. Then you have a trustee who gets appointed on behalf of the public to make sure that the fund flow is easy. Then you have a lawyer on both sides who looks at all the documentation, and the submission happens to SEBI. It gets listed. It will have an ISIN number which is freely traded, so you can buy, purchase bonds through this format. And and then you do your quarterly filings with our SEBI. So this is now a norm. This, for us, we chose to go this way, that we wanted to be there borrowing from public. There are enough competitors who still do unlisted bonds, but we wanted to go this because we want to have higher compliance, and it forces us to become better. When we are forced to submit something to SEBI, that
Mm.
means you need to have the entire mechanism at the back end working as well.
Okay, interesting. Uh, the bond market, is it liquid, or is it largely relationship driven? Like, you need an investment banker who has relationships with HNIs to sell the bonds, or do people come and trade on bonds like say equity? I mean, equity is not at all relationship driven. You go on an app and you buy what you want.
It depends on the denomination. For 10,000 rupee, you don't need relationships. You need a
Mm.
platform to be able to show. We have done bonds where the denomination was 1 crore and 5 crores as well. That's relationship driven.
And what are the platforms where you do the 10,000 rupee bonds?
So we've done it with Grip,
Okay. Okay. Hmm. Got it. Okay. Okay. These kind of fintechs. Okay. Understood. Okay.
right?
Okay. Okay. So one way of raising money is through HNIs. What are the other ways in which you could
So
increase your
we, yeah,
source
so
of
we
capital?
have we have ECBs. We are the only, probably the only fintech
ECB is
in the country,
external commercial borrowing.
external commercial borrowings, where you ask, where you get funds from outside India
Hmm.
and you use them for lending in India.
Okay.
So, there are two formats of getting money into India. One is through the FPI license. Um, you know, if you if your lender has a presence in India, they have an FPI license, then they can lend in India. The other form, they can lend in India to an entity like us, or then if they don't have a presence in India, they come through the ECB route, where they give you money into ECB, which has a tenor cap of 3 years, while an NCD has a tenor cap of 12 months.
Okay. Okay. And the cost of funds is same when you borrow from outside India?
It turns out to be very similar because the hedging cost and the withholding tax matters.
Uh, Withholding, as in you have to withhold tax when
Yeah,
you're paying
withhold tax,
interest.
TDI, because they don't have presence in India. It becomes a
Ah,
cost of borrowing then.
okay, okay, okay. You still need to pay the TDS for that to the government.
Exactly.
Okay, 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 okay. Understood, understood. Got it. Okay, okay. So these are the ways in which you can increase your capital supply, like going to individuals and going outside India.
Yeah. The ECBs turn out to be slightly better because the average tenor has to be 3 years. So you land up paying in bullet format after 3 years. While borrowing in India, all the money that you pay back is in the EMI format. It is amortizing loan. So if today I raise 100 crores, by the end of 12 months, the outstanding will be zero
Okay,
because I
so
have paid out the principal over the months. In
okay.
ECB, you have more control because
Hmm.
you now have to pay back after 36 months. So you start planning your fund flow only 6 months ahead of time.
Hmm. Okay, okay. So borrowing from individuals is like a treadmill. You have to constantly.
Absolutely. It's constantly,
Okay.
it runs out. So one of the things about leverage is to maintain a ratio, you have to constantly bridge that difference because every
Right.
month you're paying the difference
Hmm.
as principal.
Mm. Yeah, essentially, you have to make sure you have 300 crores every month with you to disburse. And that uh, out of this 300 crore, besides this, you also need additional money because you're paying back the bondholders. So you probably
Absolutely.
need something like 600 crores every month to.
Yeah, and
Uh,
plus, of course, even though we are very operationally lean, so we
mm,
are the leanest fintech in the country, with just 170 people, with the revenue base of close to 800 crores. Um, we don't think there's anyone who's reached the operational efficiency the way we have.
okay. Yeah, 800 crores is your the
Revenue.
estimated revenue for this current year, current financial year.
I'm talking about last year. The numbers were
Okay.
very similar. Yeah.
Okay. Okay.
This,
Okay.
yeah.
That
December
is
2024
fair.
numbers. Sorry, March 2024 numbers.
That's incredibly efficient. Like your per employee revenue is something like a couple of crores. That's amazing.
It's close to $3 million.
Wow, amazing. Okay, so what are the levers of profitability? How do you run such a lean ship? How do you also need to spend on customer acquisition costs? Are they a big factor or not? Uh, what are the other ways in which you can reduce your costs to be as lean as you are?
So, it's uh, efficiencies come more as we find, as a company we are all very introverted, which we find has had an impact in different ways without understanding, and getting operation efficiencies been an impact of that, because you're so inward looking.
Okay.
um, it's not that we decided that this is how we wanted. We thought everything a human can touch, let's try if technology can do it better,
Hmm,
and just have someone, because we used to see people getting bored out of their jobs. How do you keep life exciting? You can
hmm,
only keep life exciting when people keep trying new things. And if you have 2,000 people doing the same thing over and over again, then you're on that constant
the
treadmill of,
hiring treadmill. Yeah.
yes, which we are always are. It never ends because you outscale a person as well,
Hmm,
you know.
hmm,
That happens as well. And um, but its operation efficiencies come, one, because of technology. The idea that anything a technology, a human being can do, a technology should do as well. Second thing is interacting with our customers. Product convenience is something which we focus on a lot,
so
and that's why
interacting with customers gives you more retention, more repeat business.
feedback as well. What is
Okay.
that they're looking for?
Hmm. No,
You
but
know,
the feedback, how does the feedback give profitability?
you change your product needs construct accordingly.
Okay.
For example, we service the army cantonment areas, what we call internally a sentinel program. It really started with their feedback that, we are good quality customers, our salaries come on time. Why would you not provide us this product where you give us a 30-day free lookup period? And that really started from their feedback,
Ah, okay.
because we knew we could not compete with the SBI's rate of interest.
Hmm,
How do you come up with a product that they would use? Because we know they have need for money, but they're looking at the interest rate. So we came up with
hmm,
that product. We'll give you a free lookup period, and that constant interaction helps, and that's why we are able to. So 90% of our business is repeat business. We don't.
wow.
Yeah, because if you're interacting 10 times a year with us, we can service our repeat customers a lot more better.
Hmm,
And we anyway have a large base,
hmm,
but we do want to keep certain amount of money aside to onboard new customers, because that leads to innovation.
hmm. So your customer acquisition cost therefore must be really low because only 10% of your business is coming from new
Absolutely.
customers. Okay,
Absolutely.
okay, okay. How do you institutionalize customer feedback, getting customer feedback, like keeping your ear to the ground, so to say?
um so there so we have a full customer support team. Again, the chatbot does most of the work,
Mm,
while so when chatbot does most of the work, you get data and you analyze the data and you ask the questions. What is
okay.
going wrong? Where is the customer feeling the pain? Is it the customer journey? Is it the repayment behavior? Where? And we do spend a lot of time. So we have company wide meetings, and in the company wide meeting, customer support has a large say as well. What
Mm,
they're hearing, what are the kind of complaints they're getting,
okay.
and
Okay.
every department, collection, operations, credit, they speak to the customer to understand what is
Mm,
happening.
okay. 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 And what has been the evolution of technology within Stashfin? Like you told me, you use a chatbot, so that must have been a more recent thing where you have all these
It's
AI
been there for
chatbots.
2 years. It's been there for two
Okay.
years, but chatbot
Mm,
also constantly needs an upgrade.
right.
Um, being now ISO certified, that's been a very big thing for us. As we look at being an institution, we have EY as auditors, stat auditors, and we have GTS internal auditors, Grant Thornton as internal auditors. We wanted to be ISO certified as well, so we got a couple of vendors to do that for us. Now we are looking into getting cybersecurity certification as well, with all that. So there's always, when you get feedback that this is the best practice, let's do that.
Hmm.
standardizing APIs, standardizing information, firewalls, moving to the cloud, which cloud to go to. This is like a constant conversation in the company.
Okay. Okay. Uh, how has the customer journey evolved over the years? When you initially were disbursing loans in 2017 to how you
Yeah.
disburse it today, uh, what is the difference for a customer?
So when we started back in 2016, we would ask the customer to upload their Aadhaar, upload their PAN. You would then get on a call, ask them to click a picture. A field staff will go and collect the checks manually. All that was happening over a period of time. Now with digital, you would not ask them to upload any documents. You would ask them to punch in their information, and through APIs you're verifying, through government APIs you're verifying whether PAN is valid, whether Aadhaar is valid, the NASH is valid. Everything, the digital footprint in itself helps you capture a lot more information what a physical visit would.
Hmm. Okay, like KYC now is entirely digital. There is pure OTP based. Like there is nothing
There's
beyond that.
OTP, there's CKYC, then there's VKYC as well, video KYC. That's the
Okay,
next
what is
thing.
CKYC?
C I CKYC is when you upload data. I'll tell you. Actually don't know the full form.
Okay, yeah, yeah, I can
Uh,
understand. And you take
Central KYC. It's called Central
okay,
KYC,
okay,
where NBFCs or anyone who's ever taken your KYC details are supposed to upload on the CERSAI website that they've taken the latest information, whether it is for bonds or it's for lending for any reason. It becomes a central repository for KYC. You can
okay,
upload and
okay,
download, and it is mandatory to upload.
hmm.
Download is optional.
Okay, okay, okay. Got it, got it. You also used the term OKYC once in our conversation. What is
Yeah,
that?
offline KYC, which
Okay.
offline KYC, and
Hmm.
then there's OTP based KYC as well.
Okay, okay, okay.
Offline KYC is in multiple ways where you take a printout and you certify that you've
Hmm.
met the person.
Okay, which no longer is a requirement now. I think you because of
No,
the
in our
digital
case,
lending
it's not.
guidelines,
It's
uh,
not in our case, but a lot of banks still use it.
which is purely their choice. It's not like they have to use it.
Yeah, yeah, it's their choice.
Okay, okay,
They have a
okay.
branch, so I think it makes more sense for them.
The comfort with
Yeah, with
actually
paper,
meeting. Okay.
the comfort with India's paper and pen is very high.
Right, right, right. In Japan, it's even more. You will not believe the amount of paperwork they have here.
Oh,
For,
really?
oh yeah, yeah, yeah. I mean, Japan has great tech as far as hardware is concerned, but when it comes to digital, they're still like very, very comfortable with pen, paper, and a lot of those old traditions still continue.
My God, I'm surprised.
Yeah, yeah. So, okay, and there is this account aggregator framework. Is that a thing? Is that something which has adoption? Do you use it personally at Stashfin? And what is the account aggregator framework about? How is it uh, like when I first heard about it, I thought this is a game changer, but I don't hear as much about it as I would have expected to hear about it.
So, account aggregator is basically where you collect all the information on a customer of the bank accounts, the investments, the insurance. It all comes together. But this information has to be populated by someone. I don't think that has happened in a wide way. uh, it is mandatory for folks to participate, but the information provided by various banks, insurance agencies, very, very limited. So it has had adoption with, I would say, with private banks, but with PSUs, it's slightly been harder. More what we understand, it is an infrastructure issue because various people call the same account multiple times, like maybe an account insurance companies calling for it, bond providers calling for it, lending companies provided, and it has impact on bank servers and
Ah, okay.
increases the. That's why we understand it
Hmm.
has not penetrated, and no one, and it is at a very uh, I would say the cost of accessing account aggregator is maybe one fifth of what you would have if you were accessing someone's bank statement.
Okay.
So the cost to the banks for providing this information is not sufficient for them to maintain servers, and that's the reason it's not taken off the way you would expect it to take off. What we understand is RBI is working towards it to solve it, so it
Mm.
becomes economically beneficial for all.
Okay. The monetization is not strong enough currently. Like
For
what
so
you.
what's for the larger banks, who,
Mm,
the only large 4 or 5 banks in the country,
mm.
for them it's not, and if they are not there, then it's just not going to be successful.
Right, right, right. The account aggregator is paid for by companies like you. Like you would access data of borrowers, so you would pay for that service of accessing the
For what we
borrowers.
understand, a lot of people access it, as I said, insurance companies, us
Mm,
guys,
mm,
banks. um, then there would be folks who are selling you investments, pretty much everyone, because it
mm.
is a history, it's a financial history of the uh,
It
for the
allows personalization. Like you
yeah,
can personalize the product. Like an insurance company can give a more personalized policy if they can see your financial history. Okay.
absolutely.
Okay. So all these people who are accessing the information, they have to pay, but right now that payment is not enough, so the buy-in is not there yet.
What That's what we understand. This is what our account aggregator has told us, because there are certain big banks which are not there.
Right, 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 right. Okay, okay, okay. Understood. How do you underwrite?
How do we underwrite? So as I had mentioned, we have a journey where we take your PAN details, we'll take your KYC details, we'll do a lot of matches digitally in the form of, so we ourselves have close to 4.5 5 crores of database. We'll check internally in our database whether you've
What are you
applied.
checking for? Like, what signals are you
So,
looking for?
so we think, so our average ticket size is close to 24 25,000 rupees. For 24 25,000 rupees, we believe the customer will not default unless it's a fraud committed. He or
Okay,
she will come and pay back at some point in time, because this is an aspirational customer who would want access to an auto loan, a home loan, an education loan for their children at some point in time. They'll come back and pay. So a lot of our checks are done towards fraud. So we would check if Akshay's Aadhaar number exists in our database with someone else's name. If
okay,
so
okay,
we do a lot of these fraud checks. We would also check if you're using the same device and you're changing the SIM cards and applying. So what are you
okay.
doing? You could be a mobile shop company who has
Hmm.
access to a lot of people's uh, KYCs and SIM
Right.
cards.
Hmm.
So a lot of
Okay.
those checks are put in place to make sure that, and what it does, it causes burden, as I said, both on the customer and on us. And this
Hmm.
is what we want to be most careful about.
Hmm. Okay, okay. So your underwriting is largely to weed out fraud, but the interest rate is similar. It's not like you
It's risk
underwrite and
based.
decide how much
It,
interest rate somebody
it's risk.
qualifies.
It's
Okay.
risk based.
Hmm.
So the Sentinel program has interest rates close to 21%, while a person like me who comes from private company would have a rate of say 30 32 34%. So it depends on where you're coming from. And
So these are like hard coded rules. It's not like fuzzy logic where there are.
no, there's fuzzy logic in the sense that it's rule based.
Hmm.
Salary, company, your
Okay.
credit score, the kind of trade lines you have you defaulted in the past, what are
Hmm.
who are your lenders, what is your
Hmm.
payment behavior, have you ever bounced a check before, all those things. So it's rule based.
Hmm. Okay.
So we'll take into consideration a lot of parameters. We like, I know last year we did 44.1 crore API calls, and this is across various customer journeys to make a decision on giving money or not giving money.
Okay.
So,
What? Sorry.
no, go ahead.
Okay. What advice do you have for borrowers? You must have seen a lot of mistakes that people make, which spoils their ability to get low interest rates, or get access to higher limits. What are those typical mistakes people make? Is there any advice you'd like to share?
Yeah, one thing, don't forget your EMI payment dates. You know, it's very, very important uh, to make sure that you put money aside to pay your EMI, whether it's in the form of auto pay, NASH, or voluntary payment. But that's very, very important. That's one way of ruining your credit history, because it will only become stronger, it won't become weaker, and it will never go away. So one mistake, two mistakes can really impact your credit history. So suggest be on top of it. If you think you are paying more interest than you can afford to, reach out to your lender. I'm sure they can work it out. But keeping quiet and hoping it'll get brushed under the carpet, it never happens.
Hmm. Okay. On-time payment is very important for a good credit
Absolutely.
history, good credit
Yes,
score. Okay.
absolutely.
Okay. Okay. Any other advice, like what kind of lender should you borrow, for which purpose, what use case, and you know, uh, just advice on navigating loans?
Um, you know, Navigating loans, you know, you should know what you're getting into. Read the fine print. You
Okay.
know, you may think you're paying 15% interest today, but has a 6% foreclosure fee. That's a debt trap forever. You
Okay.
know,
Foreclosure essentially is like if you pay back early,
you pay
that
back
is.
early, yeah, the
Hmm.
effective rate becomes very high.
Okay.
So uh, read the fine print, know
Hmm.
all your charges up front. If someone's charging you daily interest plus charging you daily interest and then daily charges for delay charges, you should know that you really have to get this right the first time around. So don't sign up anything without knowing. And there are
Okay.
enough RBI guidelines telling the lender to behave themselves. And if you think it's not correct, you of course have the RBI portal to go to and report to.
Okay.
And it's your right.
Hmm.
It is a burden for the lender, so be it.
Hmm. Okay. 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 Amazing. Let me end with asking you for advice for another type of audience. What is advice you have for people who want to build businesses today? Like, what do you see as opportunities in India? You have a lot of data about consumer trends in India because you see people and what they're borrowing for and things like that. So based on that, what advice would you like to share?
Um, for someone who wants to start their own thing, if that's really are you asking for entrepreneurs?
Yes, for entrepreneurs.
I think India is the place to be for next 10 years, for sure. There's enough happening, whether it's AI, technology, data culling, data mining, all of those are skills one should have. In terms of opportunities, you know, EdTech, FinTech, food tech, they're all there. I think health tech will be the next one, in whether it's in terms of pharmaceuticals, in terms of easy access, readable information, all that will become very, very access. I think the fungibility of the difference in education will go away with the technology. It's really how you can capitalize, and uh, staying true to yourself is very, very important. If you think it's working, then go for it, and if you think it's not working, cut your losses sooner than later. And there are enough opportunities, and I think there are enough companies that provide you this entrepreneur in residence um, program as well. Explore that if you're not completely ready to go for being an entrepreneur and raising funds yourself.
Hmm. Within the fintech space, are there any opportunities which you think people could build for?
Yeah, I think there are lots of opportunities. For example, collection practices with
Okay.
RBI coming in and saying that you can only give money to with risk weightage. That means you give to better quality customers. If there's going to be a rate cap coming in, again, the credit will become tighter. So, how you interact with your customer, the product
So like
interaction
personalization of
becomes very
collections.
important. The means of collecting money
Mm,
also has to be very, very subtle than being
mm,
aggressive. And all that will be driven by data rather than standing outside someone's house and building the field on street stuff.
mm, Right, right, right. Okay, okay. Thank you so much for your time, Shruti. It was a real pleasure.
Quality customers. If there's going to be a rate cap coming in, again, the credit will become tighter. So, how you interact with your customer, the product
So like
interaction
personalization of
becomes very
collections.
important. The means of collecting money
Mm,
also has to be very, very subtle than being
mm,
aggressive. And all that will be driven by data rather than standing outside someone's house and building the field on street stuff.
mm, Right, right, right. Okay, okay. Thank you so much for your time, Shruti. It was a real pleasure.